and good morning to all of you. Welcome to our discussion on the accounting for derivatives. We will try to understand in this session the various issues relating to the accounting for derivatives. But before we try to do or understand how the accounting for derivatives is done, or how the derivatives affect the financial statement, let us take a very simple income statement. And in a normal hypothetical or a simple income statement, you see these common items: sales, cost of goods sold, gross margin, operating expense, depreciation and amortization. It will give you PBIT, interest, tax, and similarly you will have also balance sheet items and a cash flow statement. But if you see these items, most of these items are exposed to risk. Okay, so therefore we would like to know the items which are exposed to risk. What are those items? The sales is of course exposed to risk. When we say risk, we'll understand as we move along what is the meaning of risk. The COGS is exposed to risk. Operating expense is exposed to risk. Interest is exposed to risk. Similarly, from the balance sheet items and a cash flow, the assets and liabilities and the cash flows are exposed to risk. But what is this risk is all about? Risk is the volatility, okay, which arises from uncertainty with respect to price, foreign exchange currency, foreign exchange rates, right? So price or foreign exchange currency rates. So because of this uncertainty with respect to price, with respect to foreign exchange rates, these items are exposed to fluctuations, and these fluctuations arise because of the change in a price or change in the foreign currency rates. Now this volatility, because of the volatility of these two items, the income statement items, the balance sheet items or a cash flow items are exposed to risk, which we have seen here. But what is exposed to risk? For example, the assets and liabilities, because of the accounting rules that assets and liabilities as far as possible should be shown at the fair value. So fair values keep on changing. Because the fair value change, the balance sheet items are exposed to these fluctuations. We'll see details of that as we move along. The cash flows, you planned something to receive, but because of the price change or because of the currency fluctuation, the foreign currency fluctuations or the price fluctuations, the cash flows fluctuate. So because of this risk or because of the volatility, these items are exposed to risk, and because these items are exposed to risk, the income statement is also exposed to risk. When we say income statement is exposed to risk, then when the profits, variations of profits are exposed to risk. Therefore, though in this session we will not discuss that, let me write down the other item which is also exposed to risk is the net assets, which arise because of the consolidation of financial statement. We'll pick that up later. Because the large number of items on the financial statements are exposed to risk, the business makes an effort to manage the risk, and that is called risk management. And the derivatives are the tool, okay, are one of the tools with which the companies try to manage the risk or mitigate the risk or reduce the risk. So to summarize, because of the volatility in the fair value or the cash flow, the items on the financial statements are subject to or exposed to risk. When we say exposed to risk, there will be a huge effect on the balance sheet, income statement and cash flow because of this volatility. So the companies try to manage this risk, reduce this risk, mitigate this risk by using derivatives. And our focus of our today's class is understanding the accounting treatment of derivatives. So some of the questions we'll try to understand: what are derivatives? What are derivatives? How the derivatives are recorded initially, recorded initially, or that is initial recognition, and what is the rule, what is the principle of subsequent recognition. This is the focus of our discussion of our session today. So what are these derivatives? Derivatives, we have discussed that derivative is actually a financial instrument. So derivatives are financial instruments, and when we say it's a financial instrument, that means it is the relevant accounting standard. The relevant accounting standard for us, relevant accounting standard is IAS 39 or IND AS 39 and 32 also, but for the timing I'll concentrate on IAS 39. So the derivatives are defined like this: it is a financial instrument. So it's a financial instrument with this following conditions. Number one condition is that its value changes with response to the value of an underlying. So that means the value of the derivative is derived from the value of the underlying, and that underlying may be interest rates. The underlying may be interest rates or commodity prices, foreign exchange rate, or index, or credit rating, credit index, so many other, anything which has a value, and the derivative can be based on that value. So the value of a derivative is derived from its underlying value. The second feature of the derivative is that it requires no initial investments, or the investment required is significantly low or smaller than that will be required for other types of contracts. So the initial investment is very small, and it is to be settled at a future date. All these three conditions are cumulative. That means in order to become a financial instrument to become a derivative, or a contract to become derivative, all the three conditions have to be satisfied. So derivative is a financial instrument. So the moment we understand and say that derivative is a financial instrument, so that brings clarity to the first question, is the initial recognition. So what is the initial recognition as per IAS 39? The IAS 39 says that every financial instrument should be recorded at the fair value. And since the derivative is a financial instrument, it should also be recognized at the fair value. So the initial recognition is same as like any other financial instrument. So since derivative is a financial instrument, it should be recognized at the fair. And the fair value accounting is expected to provide the statement users the best information about the derivative on the balance sheet and income statement. And since derivative market is evolved and is sophisticated, information is available, so the fair value determination or information about the fair value is not difficult to get. But the problem, or the more difficult with respect to the recognition of derivatives, is the subsequent recognition. Okay, so subsequent recognition, what is subsequent recognition with respect to the financial instruments? So let us first understand that. When we say subsequent recognition of the financial instruments, the subsequent recognition for the financial instrument depends on the classification, and the classification reflects the intention of holding or acquiring the financial instrument. Okay, financial instruments. We know that the financial instruments can be classified into FVPL, that is held for trading, or loans and advances, or held till maturity, or available for sale. So depending on the classification and depending on the intention, the subsequent recognition is either the fair value or amortized cost. The same principle applies for derivatives too. The derivatives subsequent recognition also depends on the purpose for which holding the derivative. So the derivatives can be classified into two broad categories: held for trading, which is also called speculative, okay, or hedging, okay, or hedging, that is the held for hedging, which is non-speculative. If it is held for trading, we say that it's like any other FVPL transaction and they are shown at the fair value. Okay, so let me put that here, but though we'll see in detail a bit later, the derivative to be revalued at the fair value at the subsequent dates, and the changes in the value to be shown, okay, to be shown in the income statement, same as the financial instruments held for trading. But the important issue that we have to understand and requires a special attention is a held for hedging, or where a special accounting is used called hedge accounting. So a large portion of our discussion, not only in this session but other sessions too, will concentrate on hedge accounting. But before we get into hedge accounting, let us take an example of a speculative or held for trading or a fair value. Okay, so fair value FVPL derivative or a speculative derivative. Suppose X enters into a call option. I've already given that option or a contract as a call option. Suppose this is the information given, and we say that it is purchased from ICICI Direct or any other dealer to purchase A limited stock at 100 per share. It's a call option. The date of buying the option is 1st January. The date of expiry is on 30th April. The balance sheet date is 31st March. And suppose on this date the market price is 100, and on expiry is 120. On 31st, market price is also 120. Okay, market price is market price market price is 120. For convenience sake, we have put 120 in both the cases. And the option premium on the date of signing the option contract, Miss X has to pay 400 and she purchased 1000 options. Now what is accounting treatment of that? So first we have to find out what is the value of the option. The value can be determined on the basis of the fair value, determine using some model, okay, using the market-based models, okay, market-based models like Black-Scholes model, or I can determine as the accounting the intrinsic value, which is the excess of the exercise price or excess of the market price, over the exercise price. So if you see in this example, suppose we use intrinsic value method, okay, we use intrinsic value method. So the value of the asset, value of the option is 100 minus 100 is 0. So 100 minus 100. So there is no value because the price at which the exercise price is equal to the market price, so intrinsic value is 0. Okay, so what will happen? So the accounting treatment on the date of the transaction, we just record the premium paid. Okay, the premium is an expense. Premium is an expense, and there is a cash outflow or cash. And to derivative, since we have already seen that the accounting value, the intrinsic value is 0, no transaction will appear on the balance sheet on this date. What will happen to the financial statements? Let us see the financial statements. So the financial statements on 1st April, on the balance sheet you will not have anything. You have a cash flow 400 and a premium, an expense of 400 appears. Okay, so an expense of 400. On 31st March, that is on the date of preparing the balance sheet, the price of the share increased to 120. So the accounting value is 120 minus 100. Okay, so that is, let me put one more step, 120 minus 100 is equal to 20 into 1000. So this is the value of the derivative on 31st March. The value of derivative on 1st April is 0, and the value of the derivative is, what derivative is that? That derivative is called call option, and the call option will be recorded as an asset on the balance sheet, and the change in the value of the asset, value of the derivative, will be shown as in the income statement. So you see this on the balance sheet we show 20,000. Let me increase the font size. Okay, on the balance sheet we show the 20,000, and in the income statement on that day we show, okay, so we show the value. Okay, and since there is no other incomes and losses, we put the entire unrealized income as a part of the reserves. So I put that entire, because we are not doing the entire financial statement now. So on the last day when the option is exercised on 30th April, because the price is 120, Miss X will definitely exercise, so they will try to buy the shares, or the option writer has to give the shares. So instead of making the gross settlement, it may be a net settlement, and that is 20 per share the writer has to pay, and 20,000 is the inflow, net inflow for Miss X, and the call option is now sold or cancelled, so the cash comes in, an inflow, and it's like selling off, converting an asset into cash. So on 30th April you have cash coming in, and the option no more there, and entire unrealized gain is actually transferred to realized gain, but still we are using the word reserves, and the corresponding inflow of cash is shown in the balance sheet, assuming that no other payments. So that is the option, a normal held for trading option, that find the value of the asset, find the value of the option, and the value can be fair value or intrinsic value, and if there is a fair value you have to show right from the day one, and in this case the intrinsic value is 0 because EP excise price is same as the market price, and the premium is treated as an expense, and on every balance sheet you revalue the asset and show the value of the derivative at the fair value, and the fluctuations if any is shown as an income statement. And what is that fluctuation? In this case 20,000 minus this. Okay, so this is the fluctuation is an income, in this case has gone up. So a normal held for trading is like any other financial instrument through FVPL or held for trading financial instrument, but the accounting for the held for hedging is not as simple as that. But before we move on to the hedge accounting, let us recap and see how different is a derivative instrument from other financial instruments. The difference arises because of the payment provisions, because of initial investment and settlement. If you see the example here, the derivative call option is always valued at the payment provision is based on the changes in a stock price. Whereas for other financial instruments, if you want to buy the shares or stock, then the payment provision is based on the number of shares that you have purchased into the price. Initial investment is invariably a very small amount, whereas here the full cost has to be paid. The final settlement is a change on the difference, or the price paid is the difference, and equivalent based on the changes in the prices, whereas in this case is a delivery of stock to receive the cash. So basically the difference is because of the payments provision, initial investment and settlement. So that takes us to the next issue, that is the hedge accounting. Hedge accounting is actually a type of a derivative, isn't it? So to let us make demystified, is a type of derivative accounting, but the purpose of hedge is to mitigate the loss, whereas the purpose of held for trading is to make profit. That's why it's speculative. So in order to understand accounting, so there are three important terms that we have to understand. That is hedge item, hedging instrument, and the hedge effectiveness. Why? Because that's the way the hedge accounting has been defined. Hedge accounting is defined as a technique that modifies the normal basis of recognizing gains and losses. If you see, hedge accounting gives you an option of adjusting the losses or the gains from the hedging instrument against the losses and the gains from the hedge items, to enable to adjust to reduce, to mitigate the losses arising from the hedge item. That means since you wanted to reduce or manage the loss again of the hedge item, you have entered into a hedging instrument or hedging contract. So the changes in the losses because of the, or gains because of the hedging instrument or arising from the hedging instrument, is adjusted against the gains and the losses of the hedge item. But this treatment depends on effectiveness of hedge. So therefore, three important terms, as I mentioned, is a hedge item, hedging instrument, and hedge effectiveness. What can be a hedge item? An hedge item is anything that is exposed to risk, anything which can be hedged. So an asset, a liability, cash flow, net investment, check the balance sheet or income statement, cash flow, any item which is exposed to risk will be called an hedge item. But an important point that we should mark is that not just already recognized assets and liabilities, unrecognized highly probable items can also be hedged. That means if I say that, for example, one of the companies, let's say IKW, okay, Kalinga Iron Works Limited, a subsidiary of IDCOL, buys coal from Coal India, CIL, and the price is highly market driven. So the IKW can hedge the future purchases of coal from CIL against the price fluctuations, okay, against the price fluctuations. So it's, you have not done transaction, IKW has not done the transaction. It's an unrecognized firm commitment, or it can be treated as a highly probable transaction. So these transactions also can be hedged. So hedge item can be an asset or a liability or a firm commitment or a probable transaction. Any of these can be hedged. Later on we'll see about the net investment. What is an hedging instrument? The hedging instrument can be any derivative. So it can be a forward contract, futures contract, swap, or an option. Any of the normal derivative can be taken as an hedging instrument. So if we take that, if you take an example of IK Kalinga Iron Works Limited, so purchase of coal is a hedge item, okay, hedge item, and purchase of coal, and a forward contract is a hedging, okay, hedging instrument. You can have any other two. So that means we are saying that in a hedge accounting, the losses due to the fluctuation, due to the price changes in the purchase of coal, can be adjusted against the profits, okay, profits due to the price changes in the forward contract, okay. So if the loss is equal to, if the profits from the forward contract fully compensates the loss from the price change in the purchase of coal, then it is said to be an effective hedge. An effective hedge is one which completely nullifies the losses due to the price change on the hedge item. So that is why effectiveness is hedge effectiveness. There are several tests, and hedge effectiveness is the degree which shows the changes in the fair value or the changes in the cash flows of the hedge item that are attributable to the hedge risk are offset by the changes in the fair value of the cash flows. So that is why it's called an effective hedge. So in the next class we'll see, in case of a hedge accounting, unlike the held for trading, how the hedge accounting is treated in the books of accounts, in the financial statement. Thank you very much.